All right, today we are diving into a really fascinating business puzzle. It's all about something that sounds kind of boring, counting stuff. But trust me, the way a company counts its inventory can literally change everything. Its profit, the taxes it pays, and the entire story it tells the world about its success.
So let me kick this off with a bit of a business mystery for you. Picture two companies. They are perfect twins. They sell the exact same products, they have the exact same sales, everything is identical. But at the end of the year, one company reports a huge profit and the other reports a way, way smaller one. How is that even possible? It sounds like a trick, right? Well, it's not. Stick around because we're going to solve this thing right now.
To crack this puzzle, we've got to start with a main piece of evidence, the inventory itself. So first things first, let's define what we're actually talking about when we say a company has a treasure chest of goods. Now, here's what's so interesting. When you hear the word inventory, you probably just picture finished products sitting on a shelf, right? But it's actually so much more than that. It includes the stuff that's only halfway built, that's the work in progress, and even the raw materials that are just waiting to be used. It really covers the whole life cycle of a product. And of course, inventory looks totally different depending on the kind of business you're in. For a regular retail store, it's pretty simple. It's the stuff they bought to sell to you. But for a manufacturing company, whoa, it's a whole ecosystem of stuff. The raw materials coming in the back door, the half-finished products on the assembly line, and the finished goods ready to go out the front. Okay, so we know what inventory is, but how on earth does just putting a price tag on all that stuff actually change a company's profit? This, my friends, is where the mystery really starts to unfold. The whole secret, the key that unlocks this entire puzzle, is a little something called cost of goods sold. You'll often see it shortened to COGS. And it's exactly what it sounds like. It's the direct cost of only the stuff a company actually sold. And inventory is what tells us that number. So here's how the math works, and it's actually pretty simple. You take the inventory you started the year with, you add all the new stuff you bought, and then, and this is the absolute key, you subtract whatever you have left at the end of the year. That final number is your cost of goods sold. Seems straightforward, right? But that last little step, subtract closing inventory, that's where all the magic happens. And here it is, the crucial link. Get this. The higher the dollar value you put on your leftover inventory, the lower your cost of goods sold will be. And if your costs are lower, boom, your reported profit goes higher. It's a direct one-to-one relationship. If you say your leftover stuff is worth more, you get to say you made more money. It's that simple. So let's go back to our twin companies. Company A uses one of these accounting methods, and bam, they report a fantastic-looking profit, $500,000. Investors are loving it. But then Company B, same exact sales, remember, reports this, $350,000. What happened? The only difference between a great year and just a so-so year was the accounting rule they decided to use for their inventory. That's it. And this leads us right to the heart of our investigation. We need to meet the suspects, the different accounting methods a company can choose from that are responsible for these crazy different profit numbers. You know, you can't realistically track the exact cost of every single nut, bolt, or t-shirt a company sells. That would be impossible. So for all these identical, interchangeable items, businesses have to pick a cost formula, basically an assumption about how costs flow through their business. And the three main suspects are FIFO, LIFO, and weighted average. Okay, so the two most famous methods are FIFO and LIFO. FIFO stands for first in, first out. This one makes a lot of sense, right? It assumes you sell your oldest stuff first. Think about a grocery store that always puts the milk with the closest expiration date at the front of the shelf. First in, first out. LIFO is the exact opposite. Last in, first out. This assumes you sell your newest stuff first. Imagine a pile of sand. You're always going to scoop from the top, not dig down to the bottom. But here's the crucial part to remember. This is about the flow of costs, not necessarily the physical items themselves. And then we have our third method, the weighted average. You can kind of think of this one as the diplomat. It doesn't want to pick a side. It just mooshes all the costs together, calculates a single average cost for every item, and uses that for every single sale. It just smooths everything out. All right, enough with the theory. Let's see how this stuff actually works in practice. We're going to run a super simple scenario to see how these different methods behave with the exact same numbers. I promise, this is where it's all going to click. Okay, here's our scenario. Our little company buys 3 identical items, but we live in a world where prices go up, so we buy them at different times for different prices. The first one costs us $10, the second one costs 12, and the third one costs 15. So we have our 3 items. Now, we sell one of them. The big question for our accountant is, what was our cost of goods sold for that single item? Well, as you're about to see, the answer is, it depends. It completely depends on which story we decided to tell.
Okay, let's say we chose FIFO, first in, first out. That means we assume we sold the oldest one, the very first one we bought. In that case, our cost is $10. Easy. The oldest, cheapest cost gets used. But what if our company chose LIFO, last in, first out? Now we assume we sold the newest one we bought. And just like that, for the exact same sale, our cost skyrockets to $15. We're using the most recent, most expensive cost instead. And finally, our diplomatic friend, the weighted average method. What does it do? Well, it just adds up the total cost, that's $37, divides it by the 3 units, and lands right in the middle at $12.33. So think about that. One sale, 3 completely different costs, which means 3 completely different profit numbers. So, puzzle solved. That's how our 2 identical companies got such different results. But what does all of this mean in the real world? Let's zoom out for a second, because this is so much more than just a math game for accountants. This quote really just nails it. We're not talking about some tiny little detail buried on page 97 of a financial report. The method a company chooses to value its inventory is absolutely fundamental to whether or not its financial statements are giving you a true and honest picture of its health. So what are the big things to take away from all this? First, and most importantly, how you value your inventory directly changes your reported profit, period. Second, always remember that these methods, FIFO and LIFO, are just accounting assumptions. They're stories, not necessarily reality. And third, this choice is a massive strategic decision. Think about it. If prices are rising and you use LIFO, your costs are higher, which means your profits are lower, which means your tax bill is lower. But if you use FIFO, your profits look bigger, which could be great for impressing investors or making sure executives hit their bonus targets. So I'll leave you with this question to chew on. In a world of rising prices, like we live in, which method do you think is actually more honest? Is it FIFO, which can make profits look bigger by using old, cheap costs against today's high prices? Or is it LIFO, which gives a more realistic picture of a company's current performance, but is actually banned in most countries around the world? It's way more than just accounting, isn't it? It's about the story a company chooses to tell you